Did you know the most populous country in the world has a lot more business techniques to offer than we thought? Be it technology, innovation, or the way they survived the market crash. China has the potential to become the global leaders. Let's find out how they survived the notorious market crash. China has come up with innovative technology and so much more. But how are they keeping the economy stable, given the fact that overpopulation is a dilemma? How does China stay on the game even during recession times? China, a nation with more than 1 billion people and the second largest economy in the world in a few decades, defies comprehension in almost every way. In contrast to less than 4% in 1990, China currently accounts for 14.9% of global GDP and exports more than half of the world's raw materials. China does nothing half-heartedly. In this video, you're about to learn something that will change your life. It will change the way you think about money. And you will get rich if you understand what China is doing to crash the market. Even while it currently lags behind the US at $19.4 trillion, China's GDP was valued at $12.84 trillion in 2017, compared to barely $1.2 trillion at the turn of the millennium. Its stock market performance is also astounding. According to MSCI, it increased by 83% in 2006, during the height of the excitement surrounding developing markets, and by another 66% in 2007. It decreased by 51% the following year during the financial crisis, while it increased by 54% the year before that. Investors are becoming uneasy despite all these successes. That is not accurate. They have been edgy for a long time. Nobody firmly believes the Chinese miracle can actually be genuine in today's skeptic society. Many worry that if the economy weakens and its debts mount, it could collapse and drag the rest of the world's economy with it. There is no denying that China is now too big to fail. Given that China's debt is said to have doubled since 2007, according to the McKinsey Global Institute, there are undoubtedly reasons to be concerned. According to the IMF, its total debt is currently close to 234% of the gross domestic product, with a potential increase of 30% by 2022. Even still, the economy continued to grow at an annual rate of 6.7% in the second quarter, which is higher than most industrialized nations can only hope for. It's true that fell from 6.8% in the first quarter with the expansion of the domestic real estate market, manufacturing production, and exports all slowing. According to Craig Botham, emerging markets economist at Schroders, the government's crackdown on riskier credit has increased the cost of corporate borrowing, which has put pressure on China's economy as well. Like many others, he has doubts about official statistics. He is concerned by more dramatic disturbances of high-frequency data, which signal the economy may be decelerating at a quicker pace, even as GDP growth looks to be maintaining stable. More monetary and fiscal stimulus is being sought after, according to Mr. Botham, but it will take time for them to materialize. We could see a recovery at the beginning of 2019, but by that point, the developing trade disputes would be hampering development. The recent decline in Chinese A shares and its currency, the yuan, has Emil van den Heiligenberg, head of the asset allocation at Legal and General Asset Management, worried about China's financial stability. One of the biggest macro dangers out there is a financial crisis or hard landing in the Chinese economy. Investors must therefore pay heed. In his second term, President Xi Jinping is putting stability before growth, reducing the shadow banking sector and limiting loan growth, which is leading to an increase in defaults. However, he believes that taking action now would protect the global economy. Chinese retail investors are concerned that government efforts to de-risk the financial system will hinder growth, according to Andy Rothman, investment strategist at fund manager Matthews Asia, who noted that the MSCI China Index declined 3.1% in July, and Hong Kong's Hang Seng fell 11%. However, corporate profits are still strong, and according to him, China is still the world's best consumer story. Stock markets are still concerned by President Donald Trump's more bellicose trade war warnings, but Mr. Rothman is unfazed. He thinks the bilateral tariff conflict will be settled in the autumn, and even if it isn't, investors shouldn't panic. The impact on the Chinese economy will not be dramatic, he continues, if I'm wrong and it evolves into a real trade war. Markets are gradually becoming less sensitive to Mr. Trump's trade war rhetoric, according to Chris Beauchamp, chief market analyst at online trading platform IG, which has operations in Dubai. With his recent warning that $500 billion in Chinese imports could face penalties, he recently dialed up the rhetoric to 11. However, the markets rapidly recovered from their initial shock, suggesting that the impact of this kind of news flash is beginning to wane. Investors shouldn't panic, according to Stephen Downey, a chartered financial analyst candidate at Holborn Assets in Dubai. Instead, they should keep investing in the Chinese economy. If you accept the public figures, China is still growing robustly, and corporate earnings often grow in step with GDP. To spread risk, many investors enter China via a larger developing markets mutual fund or exchange-traded fund. China makes up 36.4% of the Vanguard FTSE Emerging Markets Index ETF's holdings, greatly outpacing Taiwan in second position and India in third. iShares China Large Cap ETF, iShares MSCI China ETF, and SBDR S&P China ETF are a few additional well-liked ETFs. A few well-known mutual funds are Fidelity China Region Fund, Invesco Greater China Fund, and Matthews China Dividend Fund. Investors should prepare for increased volatility, according to Russ Mould, investment director at online trading platform AJ Bell. There are still questions about whether China can grow at a rate of 6 to 7% annually, if only due to the law of huge numbers. Even for China, something doubling in size after a decade of 7% annual growth is quite an accomplishment. The government is attempting to change the economy away from manufacturing and exports in the building industry and toward consumption and financial services. This might take some time, and there might be some hiccups along the road. The legitimacy of the ruling party depends on the creation of jobs and economic growth. Thus, mistakes won't be tolerated. Mr. Mould observes that stock performance is not necessarily correlated with economic expansion. Big brands like Alibaba, Baidu, and Tencent have all increased in value despite the Shanghai Composite Index being in a slump. This is especially true considering China's booming internet and e-commerce growth. Since the Chinese yuan is depreciating, foreign investors can now enter the market at a lower cost. A cheaper currency might assist increase exports and serve as a buffer against U.S. tariffs. Investors should maintain their exposure to China, according to Mr. Mould, but they should also proceed cautiously. As the authorities are likely to worry at the first indication of any slowdown, China's economy might continue to be quite stop-start. The repercussions of the still remote possibility if China did crash may be far-reaching. Direct purchases of Chinese shares by foreign investors have been avoided in favor of mutual funds and exchange-traded funds. The 5 largest Chinese businesses, Alibaba, Tencent, JD.com, YY, and 58.com, according to Russ Mould, investment director at online trading platform AJ Bell, are now too hard to ignore. In a country with 1 billion mobile phones, all 5 provide exposure to the rising Chinese demand for internet goods and services. Investors believe that these stocks will also prove to be relatively resistant to any general economic downturn or U.S.-China trade conflict. For investors looking for quick earnings growth and healthy capital gains, the top 5 represent a play on China's quickly evolving digital economy. The vast operations of tech giant Tencent Holdings include social networking, mobile games, payment systems, web portals, and its wildly popular mobile chat program WeChat. Last year, its market valuation momentarily surpassed Facebook after breaking through the $500 billion barrier. Even Saxo Bank hinted that it would become the first $1 trillion firm in history, but its most recent earnings and margins underwhelmed, and its market cap has dropped to $409 billion. With a market worth of $447.8 billion, Alibaba Group Holding has surpassed Tencent in terms of e-commerce, web portals, payment services, and cloud computing. According to Mr. Mould, the company is a true multinational with a presence in more than 100 nations. With a market cap of $46 billion, JD.com is a significant player in the e-commerce industry and is said to have the largest drone delivery system in the world. 58.com, a platform for online classified ads and listings, has a market cap of $9.8 billion, and YY.com, a video-based social network, has an estimated market cap of $4.65 billion. All 5, according to Mr. Mould, may use their sizable domestic market as a launching pad for success abroad. Despite the difficulty of the Chinese stock market for foreign investors, all 5 companies now have international listings. Tencent is listed on the Hong Kong Stock Exchange, as well as through American depository receipts in the U.S., while Alibaba, 58.com, JD.com, and YY.com are all traded on the New York Stock Exchange. However, Mr. Mould claims that these equities have become extremely expensive as a result of their amazing performance. They have high expectations to live up to since they have priced in a lot of future growth. With that, the video has come to an end. Let us know what you think in the comments section to help us expand our community and attract more people who share our interests and are eager to learn. Please hit the like button. and subscribe if you thought the video was interesting. Till then, bye-bye.